If you like US stocks but don't like the risk of loss associated with them, then how about having US stocks with a guarantee of no loss? 100% loss protection sounds too good to be true, but it is the claim being made by a newly issued ETF. So in this video, we dig into how the ETF works, some of the risks associated with it, but also some of its drawbacks. Now, don't forget, if you do enjoy our content, please do subscribe to our channel and like this video. So let's look at 100% loss guarantee for the S&P 500 in a bit more detail. So how does the 100% guarantee work? Well, here's the term sheet of the ETF, and the ticker is TJUL, and everything is relative to its starting point, which is when it's issued on July the 18th, 2023. So the 100% guarantee comes for the S&P 500 relative to its value on that date. If you buy the fund, say, 2 weeks or a month after it's issued, then the guarantee won't apply to the level of the S&P then. If it's gone up, for example, the downside will be all the way to its starting point on that issue date. Notice also that the upside is capped at a 16.6% upside relative to the value of the S&P on the issue date. So you've got a protection on the downside relative to that starting point, you've got capped upside relative to the starting point, and you have a 2-year window after which the upside resets. Also, these will be issued every 6 months, so if they are popular, then you could buy the newly issued one in 6 months' time when everything will be relative to the new value of the S&P when it's issued. So this isn't tracking the S&P 500 directly. The underlying thing that we're looking at here is SPY, the ETF, which is 1/10 the price of the S&P 500 index. How's this thing constructed? Well, there are 3 things that go into it, and they're options. Now, an option is a right to buy or sell something at a fixed price at a fixed point in the future. Usually people trade options in order to buy exposure more cheaply. And this is just like a pre-packaged set of options which achieve the goals set out in that term sheet you just saw. So what are the 3 ingredients? Well, the first ingredient is the obvious one, which is to buy exposure to the S&P 500 via this SPY ETF. The way that's made a little bit cheaper is to buy a deeply in-the-money call option, which is a tiny bit cheaper than buying SPY itself. So that gives us the overall exposure to the S&P 500. The guarantee of no losses comes by buying a put option on that SPY ETF. Now, the strike of that put option is the point at which there's no longer any more losses on the S&P 500. And that's why the 100% guarantee is relative to the value of SPY on the date that this ETF was issued. That's where the put option strike is set. Now, the put option is actually quite expensive if you buy it close to the value of SPY when the option's bought. So how can you make it cheaper? Well, you can always sell the upside by selling a call option. So you pay for options, you buy, you generate income from options you sell. So you're actually just making the option strategy cheaper by selling the upside. So in 6 months' time, the upside will be different depending on the value of the put option, the call option, and buying the index overall. So we saw how the option strategy works in principle. Now let's dig into how it works in detail. And you can always skip this part if it's too technical. So here are those 3 options that we talked about earlier. There are 2 call options and 1 put option. The call option with the strike of $8 is the one that gives us the overall exposure to SPY. The put option gives us the downside protection, and then finally the sold call option, which caps our upside, that makes the overall strategy cheaper, as we'll see in a moment. Now, if it had been structured slightly differently, perhaps a simpler way of doing this might be to buy the SPY ETF, and then to buy the downside protection, you'd buy the put and you'd sell the call. So you can see 2 lines beside me here. The blue line is that deeply in the money call option with a strike of $8. And the red line is the payoff if you'd simply bought the ETF, SPY. Notice that you're better off buying the call option, and that's because it's cheaper. Instead of paying $450.84 on the day of issue, you only pay $431. So you're saving around $20 by buying the call option rather than buying the ETF directly. Overlaid on top of that, we buy a put option. Now this provides downside protection by gaining in value below its strike price. And the strike price they've chosen is the value of SPY on the day this fund was issued. So the strike here is $450.84. And that means that any losses you get on the SPY ETF are counteracted one for one below that strike price. So this is what guarantees no losses below that strike. Now, unfortunately, with options, you have to pay for them if you buy them. And this one is pretty expensive. It's $32 for the put option. So how can we make that cheaper overall? Well, what we do is we sell the upside. Now, if we're short a call option, then we're effectively short the underlying index, which in this case is SPY. Now, if you sell a call option, then we're short the underlying, which in this case is the SPY ETF. So any gains above $525.81 for SPY will be counteracted by having sold that upside to somebody else. But the benefit of selling that call option is that we can pocket $22, and that offsets some of the expensive put option premium that we had to pay up front. Now, if we put all of those three things together, the $8 strike call option, which gives us the overall exposure to SPY, the put option, which gives us the downside protection, that's struck at $451, and then we sell the upside call at $526 strike, we get this kind of hockey stick payoff. Now, I have made certain assumptions about the option pricing, about the volatility that was built into the options, but you can see I've got it about right because the payoff is as it is in that term sheet that we saw earlier. When the SPY ETF is below $450, we don't make any more losses. So our downside is capped. Anything above the upper strike, $526, caps our upside. And in between those two, we make money one for one. So if we zoom in on the payoff that you could see in the term sheet of the ETF, you can see those three options, which I've illustrated here. Now, some of you may be aware that we also have a podcast at PensionCraft called Many Happy Returns, and I co-host this with Michael Pugh. And this is usually much more light-hearted than these rather intense videos. Many people like the humour that goes with it. But in this episode, we also talk about the broader story behind things like TJUL, which is the world of structured products. In fact, TJUL is just a structured product wrapped up as an ETF. And in the podcast, we talk about the benefits and drawbacks of structured products and place this ETF into a much broader context. So if you're interested in subscribing to that, then it's available on Apple Podcasts, on Spotify, or wherever you get your podcasts. So what happens if you buy the ETF after the issue date of July the 18th, 2023? Well, remember that the guarantee that comes with this ETF of no downside only applies on the day that the ETF comes out. So if we buy the fund on that day, we have zero downside, 0% downside because of the put option. We have upside of just under 17% because of the call option which we sold, and that's our payoff in 2 years' time. Now let's imagine that the S&P has rallied by 10%, which is a completely feasible thing for it to do. The value of the S&P is now 4960, so the ETF SPY is worth a tenth of that, which is $496. Well, now the upside and downside are very different. The strikes of the call option and the put option haven't changed, so now our downside is 10%. It's not zero anymore. Also, our upside is smaller. Now it's only 6%. So the attractiveness of this ETF is suddenly greatly diminished. We've got less upside, we've got more downside, and so perhaps it's not quite so attractive if you buy this product on any day other than its issue day. Now there will be another one of these issued in 6 months' time if it's popular, so maybe it's worth holding out until that happens. Now whenever the ETF is issued, everything will have changed. The value of the S&P will have changed, the option pricing will have changed, and that means that the 100% guarantee will still be true when it's issued, but the upside probably won't be the same as it was for TJUL. Now, if you hold on to the ETF for the full 2-year period, what's going to happen to it? Does it automatically disappear? No. In fact, what happens is that the fund is going to roll into a new set of options contracts. I assume there'll still be 100% downside guarantee on that date in 2 years' time, but the upside cap is going to be slightly different. It may provide more upside or less upside depending on the value of the call option and the put option, but it won't be exactly the same as TJUL. So now let's think about the problems with the ETF, other than the fact that if you don't buy it on the issue date, it won't be providing 100% downside protection. Another problem with it is that its fee is very high, 0.79%. Now you're probably thinking, could I reproduce this ETF myself with options? And of course the answer is yes, you could. And you may be able to do it more cheaply than this ETF provider. Maybe if there's more competition in future for ETFs like this, then that'll push the fee down, but that's pretty steep in my opinion. Also, you'll see if you read the fine print of the ETF that the upside cap and the downside protection are produced before taking into account management fees and other fees. So your profit and loss will be slightly different if you take those into account. Another point is that you're giving up the dividends of the S&P 500 with this strategy. Now you might think, well, I don't buy the S&P 500 for dividends, I buy it for capital growth. And that's certainly true. It does have a pretty low dividend payout, but it is around 1 or 2%. And if you look at historic returns for the S&P 500, and these are real returns going back over a long period of time, you can see that those reinvested dividends make a huge difference to the total return. So if you reinvest dividends since 1871, the average return of the S&P is around 6.9%. Without those dividends, that falls hugely down to 2.5% real return. And while we're on the subject of real return, the other point is that the 100% guarantee is a nominal guarantee. If inflation's 8% over the next year, say, then your guarantee isn't in real terms. You will have made a loss on your capital as a result of not having an inflation-linked guarantee. And over longer and longer periods of time, that nominal versus real guarantee becomes much more important. So how can you use this product to its best advantage? Well, I think it's probably best to buy it on the dates it's issued every 6 months. That's because it's really clear what you're getting in terms of downside protection, 100%, and the upside cap, which for this issue was just under 17%. Maybe it's still buying it if you think the S&P is about to crash, because if it does have the protection kick in, then what you could do is sell the ETF and then buy the underlying ETF, which is SPY, much more cheaply. The time when it's probably not useful is once it's hit its upside cap, because if it's gone way beyond it, then you're not going to get any benefit at all past that point. There's also a behavioural case for buying a product like this, which is if you're too scared to buy the S&P 500, then having something like this may allow you to dip your toe in the market and build up your confidence. Now, I hope that's explained how this product works, its benefits, its drawbacks, its limitations. But I'd say, if I was being cynical, that many structured products are simply using your cognitive biases, in this case loss aversion, to market a fairly expensive high-fee product. But if you want to go into that topic in more detail and in a more leisurely way, then our podcast might be something that's worth a listen. Many happy returns. And you can find that wherever you get your podcasts. And, as always, thank you for listening.